Oh, the sweet, sweet ad revenue from regurgitating CNBC articles with little to no substance. I can't believe these idiots watch this. Oh, hey, how you doing there? Didn't see you there. Welcome back to Whiteboard Finance. In today's video, we're going to be talking about the national debt, inflation, and a couple of other key metrics such as S&P 500 all-time highs. This is actually going to be an article from Charlie Bilello over at Compound Advisors. I follow him on Twitter. I suggest you do the same. He has a really good way of putting pretty interesting information into visual format, which we're going to get into right now. So one of the things I wanted to talk about in this video, I may even title the video revolving around debt, is that the U.S. national debt has actually moved above 29 trillion for the first time. Okay, that's an increase of basically 6 trillion over the past 2 years. So for those of you that don't understand, what a trillion really looks like, let me give you a quick visual here. So if this is 10 grand, okay, just like this right here, we got 10 grand sitting here. 1 million is basically the size of this guy's sneaker. 1 billion is 10 pallets full. And then 1 trillion, you can see how big the guy is over here where my cursor is floating. Yeah, it's 1,000 times a billion. Okay, so this is 1 trillion. We're talking about 29 trillion right now for the U.S. national debt. So ever since I was a kid, people have always been talking about, oh, the national debt is so high, it's so crazy, we owe, bajillions of dollars to China and this and that, right? It's never really meant anything, but in the context that I'm going to present it in right here, it's going to start to mean something, you guys. So real quickly, let's take a look at this chart. I'm going to try and zoom in just a little bit. You can see the U.S. hit their first trillion of debt, basically on the new year of 1982. And then ever since then, you can see the amount of days it takes to get to a new milestone. And this number just seems to be getting, smaller and smaller. So a couple 100 days, 150 days, 28 days, 35 days, et cetera, et cetera. You can see just in 2000 alone, we added 1, 2, 3, 4 more times with 4 more trillion. And then obviously December of 2021, we just did that about 3 weeks ago, surpassing 29 trillion. So why does this matter? You can see the trajectory here to put this into perspective a little bit easier. In the 80s, national debt as a percentage of GDP was only 31%. So if you don't know what GDP is, that stands for gross domestic product. This is basically the measure of the economic output of a country. This is typically how you measure how much stuff or how much things or how much services, if you will, a nation state is producing. So you can see here in the 80s, national debt was only 1/3 of GDP. That number, fast forward 30 years later, 35 years later, excuse me, is 1-to-1. And then 6 years after that, 7 years after that, we're at 126% of GDP. So you can see that in a chart right here. So in basically 81, it was 31%, as I just mentioned. Fast forward to today, we're at 1.26x national debt of GDP. Okay, so what does this mean? So essentially, in my opinion, in my humble opinion, I've only been studying geopolitics, finance, and macroeconomics since I was 18 years old, since 2006. The reason the United States dollar has any worth, and the reason why we're not Zimbabwe, Venezuela, Argentina, Turkey, Lebanon, insert country that has seen double-digit, triple-digit hyperinflation. The reason for that is because of 3 things, in my personal opinion. The U.S. dollar is run on the petrodollar system. This is oil with Saudi Arabia. Basically, all oil is traded in dollars for the most part. If you want to stop trading oil in dollars, such as Iraq, Libya, other countries that have had some democracy visited to them over the past 10, 20 years, you can see what happens to those countries. So the petrodollar system. Number 2, the military. The military defends Saudi Arabian oil. This is the agreement we have with them. We protect the petrodollar system. Number 3 is international demand. Why would a country borrow a certain currency in their own domestic currency at X%, much higher, let's call it 6-7%, when they can borrow it in US dollars at a much lower percent? It's just a logical business decision. But we're seeing more and more countries move away from having dollars as reserves. Number 2, I think this was pretty interesting. is that this is typically the most bullish time of the year. This is being recorded on January 6th. I believe this article came out on like December 27th, for example. But the last 10 trading days in December are typically the most bullish time of the year, which we see here. So if I go to a year of the S&P 500 chart, you can see here on December 20th all the way to basically the new year. There's a nice little spike right there. So hopefully you guys can see that. Moving forward, and this is one of the charts that I wanted to touch on. I think it's pretty interesting, especially given how frothy everything is right now. This is the S&P 500 number of all-time highs from 1929 to 2021. And I believe 2021 is actually 70 all-time highs because we did have a few more trading days after this article. You can see that this is closing prices of 12.23. So I believe we did have two more all-time highs after that. So 2021 has seen almost an all-time high ever of S&P 500 all-time highs. The only other highest year, as you can see here highlighted in yellow, is 1995. So what does this mean? I'm not just regurgitating this guy's article, which was the opening joke of the video, but what are we seeing here? What are all these S&P 500 all-time highs? What does it really mean? So to give you context, I can only speak from my experience. I'm not going to be like these other YouTubers that are, pretending to be financial gurus and experts when really they started investing 2 years ago. I've been investing since 2006. And then after that, we obviously had the recession of 2008, which is the reason for all these zeros right here from basically 2008, 2012. When we lowered interest rates for basically the last, I'd say, 12, 13 years, you can see that this spurred a ton of stimulus, a ton of borrowing, a ton of stock buybacks, a ton of the S&P 500 going up and to the right, essentially, because easy money, easy to borrow, cheap money, very low interest rates. It makes sense for businesses to go borrow this money and either buy back their stock, borrow money for research and development. Tech companies have been exploding because of this. So you can see the S&P 500, which is top heavy typically with technology at this point. You can see since 2013 all the way to 2021, we've had a massive number of all-time highs. These are typically followed by periods of like 5 or 6 years of no all-time highs, which we've seen. So if you take a look at like from 63 to 68, you basically have 6 years in a row of all-time highs, followed by a period of 3 of 0. And then you have like a little blip right here in the 70s, for example. We went off the gold standard in 1971. You have massive highs after that, and then a bunch of zeros. So same thing after savings and loan crisis, same things after the dot-com bubble over here in 2001. We have multiple years of zeros. You have a little blip in 2007, and then multiple years of zeros as well. So I guess my question is, when is the everything bubble going to pop? And I'm going to make a separate video about this because I actually predicted the 2020 crash. I made that video in 2019. You can go check that out if you want. But what I think is it's all going to be related to interest rates as usual. Whenever we raise rates, asset prices tend to correct or crash. This will be real estate. It'll be equities as well. So this is pretty interesting as well. You can see here at 402 trading days and counting, this is now the 4th longest streak above the 200-day moving average for the S&P 500. So this is a cool chart that shows you that we're sitting at 402 trading days of basically SPY, that's the green line, the S&P 500. The purple line is the 200-day moving average. So if you don't know what a moving average is, this is typically the average price of whatever asset we're looking at on the chart, what its average price has been over the past, I believe, 40 weeks or 200 days, obviously. So the last one was actually from mid-2016. I don't know if you can see this. I'm going to try and zoom in. Number one was actually from mid-2016 with this green line right here, all the way up until basically December of 2018, or kind of close to December of 2018. The reason for that is because the last time the market really corrected, which you can see right here, this green line, was when the Fed tried to increase rates. When the market crashed, where my cursor is right here, maybe kind of hard to see, they lowered rates almost immediately, and you can see what the green line has done. And then we had cerveza sickness, and then we had ZIRP, zero interest rate policy, and a ton of money printing, which you can see the green line right here. That's what the S&P 500 has done. However, to parlay that into the next point, when you have a ton of money printing, you have a year of rising inflation. So if you look at the last inflation data points, PCE came in at 5.7%. This is basically the largest year-over-year increase we've seen since 1982. In each and every month in 2021, we've seen the inflation rate rise. So this is pretty interesting. So if you look at core PCE year-over-year, you can see that the dark line is the U.S. core PCE price index. You can see the blue line is the U.S. PCE price index year over year. The last time it was this high was 1982. So if you look at in times of like recessions, if you will, if you look at what happened right after 2001, it actually went down just a bit, but then went up, 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 and up. And then after 2007, 2008, it actually crashed drastically. And then we had quantitative easing during this time. If you remember Ben Bernanke, if you remember those memes of Ben Bernanke in the helicopter, like literally just like throwing money out of the helicopter, that was quantitative easing 1. Okay, that's when everyone said, hey, this is going to cause massive inflation. Why are we doing this? But that pales in comparison basically to what we've seen with the trillions of dollars, which we talked about earlier in this video. I think the biggest difference here is that there is a lot of supply chain and logistics issues. If you look at all the ports, they're backed up. If you tried to buy any furniture over the past year, good luck. If it's custom made from like a Crate and Barrel, for example, you're waiting months, dude. You're waiting 3, 4, 5, 6 months minimum just to get a piece of furniture. We've seen the housing boom continue, which is pretty interesting. So new home prices hit another high in November, increasing 19% over the last year. 10 years ago, the median new home price in the U.S. sold for $214,000. Today, it is $417,000. Okay, this is basically a 100% gain. This is basically a 2x. Okay. So this is all, as I've been preaching on this channel for years, this is all related to interest rates, folks. When rates are low, asset prices are high. When rates are high, asset prices go down. It's very simple. Don't try to overcomplicate this. So higher premiums, higher profits. This is pretty interesting. The average family health insurance premium in the U.S. has more than tripled since the Affordable Care Act. I love how he put that in quotes. And the biggest beneficiaries, health insurers. United Health Group is up 1,700% versus a 404% gain on the S&P 500. So if you would have bought this in basically 2011-ish, 2010-ish, since the Affordable Care Act of March 2010, you can see what this stock has done. So again, remember everybody, America is a great country. In order for you to get rich, there's a lot of opportunity here. But if you're in the middle class, you are pretty much getting it on all ends of the spectrum with no lube. So number 6, supply killed the SPAC boom. We saw over 600 SPACs launched this year, totaling $162 billion in issuance. If you guys follow the SPAC boom from basically 2019-ish, 2020-ish with like Chamath and everybody releasing their SPACs, you can see a crazy number just over the past two and a half years or so. So this is basically taking a look at this ETF it's the Defiance Next Gen SPAC, okay, ETF. It's down basically 25% on the year. And you can see what the S&P 500 has done. So he's basically saying, hey, this big SPAC boom, there's too many of them. A lot of these things are dog crap. Only a select few have done really well, as you can see here in the beginning of the year. After that, it's just been a decline. So I'm not going to finish the rest of the article. It goes into like cerveza sickness, which I'm not going to talk about on this channel. But what I wanted to just hammer home, the whole point of this video, is that we're getting into unprecedented territory. Again, this is not a fear-mongering channel or anything like that. I let my viewers do their own due diligence. This is just a tool in your toolbox to make your own common sense investing decisions. But what I'm going to say is when your GDP or when your national debt to GDP is at 1.26% or 1.26x, 126%, you're starting to get into territory where you may lose your world reserve currency status, which is one of the things that hold up the dollar, in my opinion. International demand, military, petrodollar system, world reserve currency status. If you like the video, give it a thumbs up. Please share it. I may just start doing these clickbait thumbnails, just to try and get more views, but I really don't care because I don't care about the views. All I care about is that you get value from my videos. Check out the links in the description below if you want to support the channel. And as always, have a prosperous day. Yeah, Jim Cramer, baby. Let's go. Bye, 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 bye. It's so easy to make that kind of content. But then again, I just reread someone's article trying to add my own context. Thanks, guys. See ya.